I think you have to distinguish between the economic cycle and the market cycle. I think from an economic cycle perspective, I think that there is still a reasonable way to go. I think there's still quite a bit of slack, for instance, if you look at unemployment rates. Typically, over the last 40 or 50 years, cycles have lasted at least 5 years. So I think with central banks still being very supportive, government still providing a fair amount of support and more support coming, as you have just said, in the US, I think the economy can keep going. But we are going to transition from very high growth, maybe just to more normal growth, and it's hard to distinguish between that transition and, say, slipping into recession. So I think there will be moments of doubt. But yes, markets are pretty expensive. And so I think that although I would favor cyclical assets over the next year or two, I think the return premium that one will earn from those assets is not what we might have seen in the past.
What I think is fascinating about your approach is that your diversifier in this story is not necessarily the obvious fixed income route, but cash. Can you just talk us through that then and what that means for portfolio construction?
Yeah, I mean, I always say that, the great thing about cash is that although you know you're going to get nothing, you can count on it being zero or close to zero. And that lack of volatility plays a big role in a portfolio, as does the lack of correlation with other assets. It's hard to find assets that are uncorrelated, and cash fulfills that role as well. So when all assets are rising, cash is clearly a drag on performance. But in those moments of volatility, it does provide diversification and stability.
Paul, good morning to you. By the way, we're absolutely loving your shirt, by the way. It looks fantastic. It's exactly what we need to see on Business News, rather than the dull
put it
stuff.
On specially for you guys.
No, I hope so as well. Can I reveal a little secret? Jeff just said to me it's more Jackson Pollock than Paul Jackson, which I thought was a great line. Don't mean to get my colleague in trouble there. But anyway, it was better than my line. Look, you're writing off IG. I don't mean IG index. I mean corporate IG, investment grade, holding zero advantage over cash. I think that's fascinating. Why are you so pessimistic on that compared to high yield, which, as you and I and Jeff both know, or all three of us know, it's not actually high yield anymore. So you like a bit of, well, not like a bit of high yield. You've got a neutral on that one, but zero on IG.
Yeah, again, it comes down to valuations. It's not that I dislike IG, it's just that it is pretty richly valued. When you've got spreads as tight as they are, and both on high yield and investment grade, those spreads are pretty close to cyclical tights. You have to ask how much further that can go. So you're basically relying, when you look forward in terms of returns, you're basically just looking at the yield. You're not going to get anything from downward movement in the yield, or very little. So IG yields being lower than high yield yields, I think just makes it less attractive. And when we run all of those potential returns through an optimization process, it basically says, well, you might as well have cash rather than IG. You've got very limited risk with cash. You do have some risk with IG. And high yield, there's just that extra yield buffer that maybe makes it worth a little more, and it does give you a bit more of a cyclical kicker.